I'll just start the session with some introductory comments, and then I'll request each of the panelists to have a few introductory comments, and then we'll make it a little interactive amongst ourselves, and then we'll, of course, open it up to the floor. So we've seen, of course, the financial markets really opening up in the early 90s, which was also coincided with the unraveling of a big scam and the setting up of SEBI as an independent statutory body. And we had a Cambrian explosion of laws. Something which did not exist before was kind of on the table. And I think the previous to this new regulatory regime, we, of course, few people had a seat on the table and the rest were on the menu. Obviously, order was needed, and we had a whole new set of regulatory regime which is intended to dry the swamp. Of course, that has not meant that frauds have dried up. We've had frauds happening with very, very predictable frequency, one which we just seeing in great detail play out with the offender having run the country again. Of course, well-regulated markets have a great future and always will. But at the same time, it's, regulation is seen as seen as imposing costs. It seems to pull you back. But it also has a driving force which pulls the market forward. People have more confidence in the markets. There's general faith in the market. People raise capital. The economy grows based on that. But big bang reforms like what we saw in 90s and even the late 90s, another set of big bang reforms happened in the capital markets when we had things like dematerialization was issued by way of a fatwa by the regulator, which is very unusual anywhere in the world. But it's had a huge impact in terms of transmission losses getting virtually eliminated, speed, the T plus whatever 2-3 months it used to take to register shares went down to T+3 and now to T+2. So we've had two sets of relatively big bang reforms, early 90s and late 90s. And then, of course, there have been incremental reforms which have occurred. So before I kind of talk about the regulatory cholesterol, so to speak, I just want to start with a little story of an experiment which was conducted on 5 monkeys. They were put in a room, and they had a small little ladder, and some bananas were put up on the top, which were hanging, and which could be caught by the 5 monkeys. So every time a monkey would climb the ladder to pick up the banana, a huge quantity of cold water would fall on all the 5 monkeys, not just the monkey which is climbing up the ladder. Till the time they figured out that there's a causal relationship between going up the ladder and cold water falling on all of us. So they used to beat up the monkey. Every time any monkey would try to climb the ladder to get the banana, they'd start beating up the monkey. Now this experiment was continued till the time they replaced one monkey after the other, till all the 5 monkeys, they brought in a new monkey and replaced one of the monkeys which on whom the cold water was put. Till the time all 5 monkeys had never experienced cold water at all. And all the 5 monkeys would still beat up any monkey which tried to climb up the stair. So the point is, of course, that we continue to do things the way they are. We continue to regulate the way they are, despite new frauds coming out. And as they say, in politics, they say you campaign in prose, but you govern in you campaign in poetry, but you govern in prose. So similarly, in regulations, I think you typically you're very happy with writing regulations. So you kind of regulate in poetry, but you enforce in prose, which means the kind of enforcement always lags behind the actual rule writing, which regulators are very happy writing new rules. So with these opening comments, I'd invite each of my fellow speakers to give very short 3 to 5 minute introductory comments on the subject of growth, the cost-benefit analysis, impact of regulations on that. And after that, we'll have kind of an interactive session amongst us. Thank you.
Good morning, friends. It's a pleasure to be this ET Summit. Very unusual subject for me to be be part of this. But I think it's interesting to, at least it allows me to look back and see what has happened, and maybe something I, from my perspective, what could be relevant. One of the things I have seen that I'm probably one practitioner who was pre-SEBI and post-SEBI, in the sense that I have seen worst of, before 91, I started buying stocks in 1980, and so I had 10 years experience of before SEBI came into being, and Mr. Ramakrishna was particularly good friend of mine, in the sense that while nobody bothered about the authority of SEBI, in fact nobody had heard in BSc forum and all, nobody had heard about SEBI, and they used to think that they are the guys who, with 2,000 square foot office in Nariman Point, we have a full tower. I said, "वो तुम्हारे बाप हैं." That time the professionalism was not there, and they used to strike against SEBI, that they don't want to get registered, they don't want to do this, that. So that was the kind of era, and it is not the scam which brought SEBI into. SEBI was already there. In fact, that very day when the scam happened, I had 1 hour interview with Mr. Ramakrishna, and evening I was to meet Mr. Maya. He was the president of BSE, and BSE was all powerful at that point of time. There was no NSE. In fact, the birth of NSE is because of the scam. Because BSE still didn't relent to listen to what was SEBI or Ministry of Finance and all. Then finally Manmohan Singh and all, they started NSE, and the first meeting was in SBI auditorium, where they inaugurated this thing. And the way you could buy membership of NSE was go, and maybe there was one small exam, and just sign and get the membership. That was the kind of thing. And then we have seen the markets evolving. It has become so safe. It was absolutely unsafe. T plus 21 was a typical settlement cycle. Officially it was T plus 15. It was actually happening most of the time T plus 21. We used to have 177, 178 days trading, which is now 220, 225 days. So it was all over, and brokers were very powerful. Unbridled insider trading. There was no discipline on the disclosure. So I think markets have come so much. So you cannot compliment less the SEBI in terms of regulation. From a completely unregulated, indisciplined market to a completely disciplined and a very reliable market, Mr. R.H. Patil and all, they've done wonderful job. So there is no 100, I would say 110 on 100 for regulation part of it. But now I think that their mandate is to regulate and develop. Now this development part, first of course you have to regulate it safe, make it safe. You cannot grow unless you are regulated well. We are probably, I think this market is the most transparent market in the world. To the extent it is hurting us. It is really hurting us. As an asset manager, it is very tough to keep your trades not known to the market as a whole, because people do front running whatever we buy. So it has become that hurting. So I think the opportunity here, there should be some developmental targets, that penetration of equity should be from 2%, it should go to 20% in 5 years' time or 7 years' time, or we should be managing 5% of the global money out of India. You go all over the world, it is all managed by Indians. Everywhere in the front, whether it is global American equity, Indian equity, American equity in America, there are a whole lot of Indians out there. We are very, very fit kind of a mindset guys to manage equities. But this round tripping clause where I cannot seed my own fund for raising money. If I go abroad, I say, give me $1 billion. They say, where is your skin? You put $50 million in the fund, we'll put the next 50. But I cannot do it. You go to RBI, they say it's a round tripping. I said, in next 24 hours, I'll buy that $50 million worth of stuff in my own fund, which in any case is lying in my fund. I'll just replicate it, but it will come via whatever is the thing, so that other person can see by way of skin in the game. And skin in the game in the global markets are so big. To get $1 billion, you have to first put 25-50 million. That you cannot do it really. So I think the regulations and the multiplicity of regulations, they are having made the markets very safe. Now the opportunity is to make it really big. Big in India for the domestic savings to come and do a wonderful job of that. But second is the really making it available for the global citizens coming into India. How do you make it easy? I meet so many guys, they are frustrated how to invest in India. Indians themselves, sitting in Dubai, America and all, they are frustrated because the intermediaries out there, they are trying to make 3%, 4% out of that. How can they access? They know the market. They're very comfortable buying whatever SBI or anything, but they're not. They don't have channels, and I think regulations are against, or it is not. They don't bother about the development of the market types, So I think the agenda should move from only regulation to regulation and development, and I think we can, this agency or regulations can become really fulcrum for giving extra impetus to the economy itself. I mean, because unless the savings get channeled into equities, who's going to take the risk? I mean, finance ministry can't be writing
But to be fair, things have developed a lot. We've seen SIPs of $1 billion every month versus, 15 to 20 billion. Yeah,
the potential is much bigger. I mean, we are talking about $2.5 trillion economy with 30% savings, $750 billion annual saving growing at 10%.
But at least directionally we are in
Directionally, no doubt. Directionally, no doubt. But just the potential.
So I think just let me take off on your point of, the whole concept of calculating output. That is very well put in terms of, our regulators are not focusing on development as much as they ought to. They're focusing more on the regulatory aspect. And in fact, as part of a cabinet secretariat task force on measuring performance of ministries and departments, and invariably they used to feel very surprised. Because they were used to inputs. They used to say, okay, last year I got 2,000 crores for animal husbandry. This year I'll get 2,200 crores. There's no concept of calculating the output that, for instance, disease in cattle fell from 18% to 15% was not a metric at all. So that was a very interesting task. So with that, Uttam, your kind of opening comments on...
I totally agree with Ramdev ji that, the markets around the 90s were highly inefficient. Though I wasn't in the market, but my firm is 60 years old, so I have some... Marwadi bacha is always working since he's born, right? So, here we have 92, 95, SEBI was set up, was given almost unlimited power to get things sorted. And we had, today, I think one of the smartest government body in the world, in India, full of CAs, MBAs, extremely young guys. Now, their job was to improve. And from what the market was till what is today, I think India is world class. As part of various international organizations, I know that we are the world standards in many things. But we still have these 500 people whose job is to improve. Samay badal gaya, market badal gaya. Now, the fear or the feeling that we get is sometimes we get change for the heck of change. Arey kuch change nahi kiya, let's bring a new regulation. When market has already reached a particular level of working, of efficiency, regulatory stability also has its own value. So that is one part which I really think the message has to go to regulator कि boss जो तुम कर रहे थे वो बहुत अच्छा था कि सुधार की जरूरत थी काफी सुधर गया please don't change just for the changing. This is one part that I as a market participant often get a feeling. Again, development has to have focus. Securities lending borrowing has to take off course. You have to do things to make it work. Interest rate futures, abhi tak, it is where it is. Getting the international smaller investors to invest seamlessly in India, probably that is an area which has just not got attention. Regulation has taken a serious priority over development, but probably we'll go on this. Second is again regulatory action. Non-compliance, anybody who's been a market intermediary here I would really put you in the category of SEBI Pedit. Okay, anything you do, boss, I don't know what is the implication of what is going to happen to me, how the regulator will view at this. So, at times we feel the punishments is not commensurate with the offense created. Something like a promoter who has not done, who had bought an issue in 1996 and not had a single purchase of sale, single sale of shares, if he has not done his regular takeover court filing, which is supposed to do, and ignorance of law is obviously not an excuse, but the penalties for that is humongous. Because मैंने ऐसा क्या कर दिया, हर quarter shareholding pattern there is no change, but there is a technical violation of law. You did a PIT filing, you did not do SSC filing. Sorry, you are a bad man. This is very, very disturbing. And as a regulator, obviously you have to regulate. Probably what about education? Everything is about investor education. Is the regulator, probably a regulator look at intermediate education, would look at listed companies education. How can you not do silly things? It not a simple certification when I say that's not a thing.
We'll come to the specific point.
Yeah. Okay. Two more general points are a cost benefit. Every regulation that has to come, there is some benefit, but what is the cost in terms of the operational effects on the markets, the participants, the various stakeholders is something that should be there. Every regulation probably needs to come with a sunset clause. Okay, after 10 years, this regulation will end. Either will come out with the new regulations, revise it. Once in the statute book, it's there forever. These are probably the broad points that I would like to bring out.
Just on cost benefit, just last week the insolvency regulator has come out with a draft regulation of how to draft regulation. It's very instructive. It's 4-5 pages long, and which is what is contained in the FSLRC committee report. They want to bring in terms of how to approach the public, get feedback from experts. And if there's a dramatic change, bring it again back to the public for comment. So there's a lot of good points which they're doing in terms of measuring the cost benefit. Of course, cost benefit comes with a pinch of salt, because it's pretty easy to measure the costs, but the benefits are always very intangible. So to put a numerical number to the benefits is always a challenge, and regulators have tried to justify it. So now we have two Mr. Gupta. So I'll start with Dr. Gupta with the broad points on feel free on the the governance matrix and what you think about the cost benefit analysis.
Thank you, Sandeep. Good afternoon. What I find is the topic very interesting, regulating for growth. It comes to my mind, Sandeep narrated one story. I'm not narrating a story, but it's just like, a case of a crash when the train is running too fast and get crashed. If you imagine this situation, you may think that it's better to have some kind of controls or may slow down. So there'll always be a conundrum. Whether we should slow down and reach to the target slowly, or we should have some controls and even reach to the target with certain pace. My dear friends, in 90s, when the economies were open and we were talking about market-based economic policies, so that was an interesting tilt in the thought process, which of course started in US somewhere in 70s. And that again was a time when on a contemporary basis we have seen failures in banks, banking crisis and all. That leaves us to a situation to interpret something. We may interpret that market-based economic policies are a failure, or we may interpret that banking failures have taken place because of the deregulation thing which has come up. But I think none of them is true. We need to look at it in a much balanced fashion as the topic goes, that we need to look for a right balance. Regulation per se always has been considered as something substantial and something sensible, which has to be in place for not just from the control perspective, but from the growth perspective as well. And what I personally feel, regulators keep that always in mind. Of course, there might be some contrast in terms of intent and content at many the times when we drop the regulations, or maybe that come up and we come across the markets addressed to that particular kind of thing when the real implementation takes place or enforcement takes place. So that could be some question which may create a panic in the mind that regulation is just a control and not leading us towards the growth, or it really has that. So definitely, one thing which we can conclude is regulations have to be there, but the implementation and enforcement in a manner which ensures efficient control for having protection of the market, players, products, and different practices, as well as the growth orientation. Now, one more point which just I would like to add is, if we look at the regulation framework, I mean, I'm not talking specifically with reference to any particular regulation as a hindrance to the market or as a promoter to the market practices. If we look at the framework, there are three things always which I consider important. One is the economic regulation. Another we can consider as safety regulation, the regulations which infuse the element of safety. And the third, which is very, very important, specifically with reference to the emerging countries like India, the information regulation. When we talk in terms of deregulating things, when we talk in terms of revising the regulation, definitely the economic regulation has to look at the aspect in such a fashion that the regulators create regulation on an overarching basis and should inculcate the practice of self-regulating organizations, where there should be some liberties, there should be some level playing fields, there should be some space where you can self-regulate yourself and adhere to the basic principle by which the overarching regulation has been created. But if we look at the equally important part, the safety regulation and the information regulation, the kind of prudential regulation and the kind of corporate governance related regulations, security market regulations, they are substantially important. And if we put a glance on the present practice, we find, I think in the last session, people were talking about the change in the practices from 2014 to 2018. The real intent has changed. We have tried to make things expedient. We have tried to, government has tried to, simplify the process, not only just the process, but has to look into the hurdles which were there earlier in enforcement and implementation. So, things are changing. We are eyeing for better rankings on the global level, be it be the rankings relating to the financial markets per se, or it be the rankings with reference to ease of doing business. We have come up with the bankruptcy code, which again is a very important element which has to be present with reference to the operations of finance in the whole economy. So many things are changing, and many more frameworks, tighter frameworks are there in place for ensuring better safety to the capital markets, and which nowhere, I personally think, hinders the growth element into it. And the third element which I was talking about, the information regulation, we all understand that financial markets, operations, engagement and involvement, participation of the stakeholders have a very important role with reference to the availability, access and utilization of the information. Information asymmetry exists. So that kind of thing, that regulation, regulating the disclosure practices, regulating the transparency, again is something which I don't think as a hindrance to growth, because that is something which really gives each and every player an opportunity to engage and communicate with the stakeholder, by which they can really show as to how much real value they are adding. And lastly, I would like to just, refer to Colin Mayer. When I was hearing him, he said the biggest reasons why market entrants or the corporations fail, because there is always a paradox between value and values. So we need to focus on both equally, from economic, from safety and information point of view, and we should consider, and again, definitely in the discussion we'll take this forward as to how regulations are really hindering growth and how they can be eased out and more simplified, so that it's not just player, it's the question of the whole economy, how we are portraying ourselves to the whole globe. So let's take this forward. I'm up from
Thank you.
my side. Thank you.
Thank you. No, so I think the disclosure point is important, and again we are living through that whole episode where in October SEBI came out with disclosure norms which they withdrew, in fact, which is very unusual, probably from kind of some pushback from the central bank maybe. The whole concept of disclosure then
recognition, and then finally resolution has actually been reversed in India. We're seeing, suddenly in the press, we're seeing bankruptcies happening. Then we have recognition on the books of the debtor, and finally we have disclosures. So we are actually running it in the exact opposite direction. At some point we'll have to reverse course and do it in the right manner. So with that, Mr. Gupta, your kind of opening thoughts.
Thank you, Sandeep. My fellow speakers have made certain points, so it is my duty to start. The first thing is this, that Ramdevji said that growth and regulation. I very simply say that both are equally important. You can imagine they are the two wheels of a scooter. Without one, you cannot drive the scooter. So, the story is chicken and egg, which is important. And I don't think that one is important over the other, both are important. Then my friend made a point that excessive regulation, more regulation. I have been a regulator myself, rule making, and Sandeep has also been there. We are not having fancy for making regulation. It is not that my wife did not give me a good breakfast, so I decided to punish you and make a new regulation. We are forced to make a regulation. And I always make a point that tell me that frauds happen, cheating happens. How many of the participants of the market have ever complained about frauds or likely frauds which are happening, except in cases where you have a personal competition and animosity? Has any of the SOCM, FICCI, CII or any organization said that we will not enroll this corporate as a member because he is doing fraud in the system? Not one in last 70 years. So the issue is, when you tell that all responsibility is of SEBI, RBI or somebody for regulation, then we have a limited resources. Uttam's point, proportionate punishment and technical compliance, I give, when he said that non-filing of the shareholder pattern. As far as if I have to file, it is a very small technical compliance. But ask the answer from those who are trading in the market. Now, if they do not know who are the shareholder or what is the shareholding pattern, their trading is clouded with lack of information. Then the issue comes, excessive regulation. I agree. There are excessive regulation. The issue is, unless until we come to a system where you have limited number of regulation, but implementation is very, very effective. But don't blame SEBI for this. Where have you seen success of self-regulation? I run a company. Yesterday we were doing a report, and you will be shocked. The law requires cost accountants to be appointed by companies which are in 3 different sectors and blah, blah, blah. There is a self-regulation by Institute of Chart Cost and Works Accountant that what is going to be the minimum fee to be paid. And out of 390 companies, 354 companies have paid fee which is almost 50% less than what is the minimum prescribed. So what are you doing? The companies which have got more than some lakhs and lakhs of turnover, have 62,000 crore of profit, have saved just 13 crore rupees on the fees. Now all savings you are going to achieve through saving on the audit fee. Now the concept of audit is not there. So my issue is very clearly that yes, I agree. If you see the prospectus today, if you see the disclosure today, they are excessive disclosure, excessive thing. So that the information is hidden, and that suits many of us. I was in SEBI when I am doing investigation. So what will happen? The person will give me thousands of paper for in reply. Now you got to search through thousands of paper of the 2 relevant paragraphs. So that is the issue. I agree that we will have to battle with this. I think we'll come to specific later. Thank you.
So let me start with a couple of questions to my fellow panelists. Let me start with you, Mr. Ramdevagara. The whole concept of over-regulation I'd like to take one or two examples, one from kind of your industry, two from your industry in fact. One is the whole concept of KYC as we see it in India. I think we've gone way beyond what other countries have done, and in fact we've confused identification with KYC. They're completely different concepts, the whole CERSAI, and they basically are, if you look at the form of CERSAI, which is a unified KYC form, is basically an Aadhaar form. It just proves your address, it doesn't prove anything beyond that. And KYC as globally understood means you need to sell the right products to the right people. We do very little of that in fact, except few outposts in metro cities, etc. But my point is more limited in terms of, have we created KYC which is an exclusionist KYC? And are we kind of disintermediate, are we forcing people out of the system because we made it so complex?
When we started I started broking sub-broker as 87. So that time everything was paper based. And at that point of time, say I meet you today and we'll talk and we like, and I say, you'll ask me what share to buy, I'll tell you, you buy say 200 Reliance or something. Yeah. That's it. And tomorrow I'll execute and then I'll call you up in the evening that Sandeep, what's your phone number or address where I can send the contract. I still don't have the check because check is needed after 15 days. And we never had any problem with the system because the other person is coming with the money to invest here. He's not borrowing from you. You need, of course you need to know where he stays, whether he's Indian citizen, those basic 4-5 things, address proof and all, that is okay. But, he's actually bringing his money and dumping it in the market. So what do you need to know? When you buy Reliance, you're putting 2 lakhs rupees here. Now, you are interested in safety of your money rather than I'm interested in seeing who's this guy? Why you exclude him? Today it is almost impossible for the very small guys to enter the market. And I'm talking about simple equity markets. Earlier you needed PAN card. How many guys can get PAN card from rural India or semi-rural India? So it has created a very exclusive kind of club for the guys who actually are very well off. And they probably don't need support of equity markets. They themselves are businessmen. They have their own equities of their own businesses. But the small guys, teachers and then pensioners and all the 98% of the people, 99% of the market, they find it equity market to be something very complex and for the rich people or some select set of people. That is what it has achieved in last 15-20 years of very stringent, and you see some of them are unreasonable in the sense that you want this copy, that copy, and which is just duplication of the things which are not there. So I find it, this has happened now.
Any solutions that you can think of in terms of, because we still, I think if you look at the amount of savings which goes into the equity markets, we've been in the 4 to 5% for the last 20 years almost.
Yeah, see, I think authorities must look at it. What happens is the multiplicity of agencies, that creates problem because they say we have to listen to this guy for some fraud thing. Now America has problem with FATCA or something. Again it comes back here. So I don't know whether there is any cohesive thinking. Something must be overriding everything. There should be SEBI chairman when he comes for next 5 years. I think he should be given his KRA. You do this regulations 3 point, but there should be one paragraph on targets on regulation. There should be second paragraph on development. So and then he's the guy who can strike balance, and they will find solutions. I don't think an individual can suggest a solution.
I think that's a great point in terms of, and I'll give you my kind of anecdotal evidence. So after SEBI, I moved to Ahmedabad. I was teaching full time there as a time, and I went to a local public sector bank. They actually refused to open a bank account in my name. They said KYC. I said, what KYC? I have a letter from the director of the institute. I'm employed by them. They said, no, unless you have a lease deed. I said, I don't have a lease deed. They're providing me a housing. I don't have any other proof. You have my ID. I have my passport, which is of course based in Delhi and all that. So they actually refused to open a bank account in my name as a full-time faculty at IIM Ahmedabad, and they refused to open a bank account. Imagine what the problems which a small farmer in a remote area would face, who's moved from his rural area in Jharkhand to, let's say, Mumbai to work on a metro construction. It's really painful, and we're talking about very basic banking stuff. We're not talking about fancy equity products.
Stock exchange where you can literally buy in 145, 150 countries on a press of a button. The most difficult part of the registration is India. They have to do special work.
No, I don't mind it being difficult. I have a problem with it being completely useless.
Yeah.
Difficult is fine. I mean, you want to have stricter standards, I'm completely fine with it, but not allowing you to open a bank account because I don't have a proof that I live in that city is, I think, just... So, Uttam, coming to you,
KYC, the question you asked is, what should be done? Well, stop doing anything. Stop changing stuff. Alright, there was a simple KYC once upon a time. Then some smart person decided, we'll have a mandatory, voluntary, separate. Fine. Then somebody decided we'll have MAPIN, the stock market's Aadhaar, which went away. Then somebody decided we'll have a KRA, where you have to physically submit the documents. They said, no, send the scanned documents. Now KRA is out, now we have a central KYC, CERSAI. Beach mein we had a Saral form because my case is too complicated. Boss, chahte kya ho? Even in FATCA CRS declarations, which is the international obligation, it's only for new clients. For the old clients, you don't need to take any declarations. You can just go on what is on your record unless he's a particular HNI level. Please have some common sense. That is all. Now tomorrow KRA will go away. The CKYC will remain. CKYC would have a different style of for non-individuals. The changes are dramatic. That is the biggest problem. How do I onboard my client? Just stop changing things.
SEBI chief should be make the market inclusive. Let him decide because he will get a lot of advisors to tell them.
No, since you're mentioning, in fact, Mr. UK Sinha, when he joined SEBI, one of his first statements was that I want, for instance, opening a brokerage account should require only 1 or 2 signatures.
Yep.
It's still 40 to 50 signatures, even today. Mr. Gupta.
That is what I'm coming. That I agree that KYC is a difficult process today. But what the industry, has anybody from the industry said this is what is the simplified KYC we want? Second, industry has not done anything to simplify the document that they want. When I open Demat account, when I open brokerage account, read right here, left here, this on the blank piece and initial here. I don't know what I am signing. The issue is that why don't the industry go to SEBI? I have already spoken to SEBI chairman on this, that let there be standard text for everything. You don't, when you buy railway ticket, there is a contract which is you don't read. So there should be a standard for everything which should be on the SEBI website and the broker's website. And any deviation, that only should be typed on a piece of paper and signed, so that I know what is the deviation from the standard which is not there.
They'll make a 40 pages letter of deviation.
Then the regulator has to approve that deviation. The issue is that you can't say that, okay, I have 40 pages of original document and 40 pages of deviation. No, then you are not fit for doing it. But the issue is that we got to work hand in hand with the regulator. I totally agree with you. I am myself tired. Because when you open account, 20 pages you sign and all the things. So we have to work together.
But Gupta ji, we signature आपके बताए हुए हैं. Intermediate तो चाहता नहीं है इतना paper work हो.
मैं तो बोल रहा हूँ कि मेरे बताए हुए नहीं है. मैं तो बोल रहा हूँ आप एक 1 pager deviation का sign करा लीजिए, बाकी standard का मत sign कराइए.
This is exactly the suggestion already given by me as my association to SEBI. A 1-page simple KYC.
Write it to SEBI chairman. Let us see.
Okay. I think so. Let's moving on from KYC. I think if we can get Dr. Gupta on the next point, I think maybe all the panelists can comment on. It's been almost 7-8 years since the FSLRC committee came out with unification of regulators. We've had one unification between the Forward Market Commission and SEBI. We've had some tough wars between regulators. We've had overlapping jurisdictions. We've had gap in regulations. We've had Ponzi schemes where those gaps exist. So we've had a lot of problems in terms of multiplicity of regulators, some regulators not kind of clued into a particular space, or sometimes it's like, like Socrates said that a slave with two masters is free. We've had that as well. So we've had many areas like the corporate bond market where RBI, SEBI both kind of are trying to play together, and ultimately, the market doesn't develop because of this overlap. So, Dr. Gupta, your kind of sense in terms of where you see this whole concept of a unified regulator, or do you think it's not a good idea at all?
Well, when we look at the multiplicity aspect, which you were talking about, in terms of regulation, having multiple regulators in place is not something which is unique to India. If we look at the global level, even in most developed nation, that is US, you will find there is multiplicity of regulatory bodies. Specifically, I'm talking with reference to the financial sector. And in many cases, the researchers have proved that the multiplicity is not something which is bad. What is a bigger challenge is to look at their jurisdictions, well-defined jurisdictions, and try to remove in case any sort of overlaps exist. I'm not going far in this, not bringing more into picture. Just 2 points I will make. If we look at SEBI and say Ministry of Corporate Affairs, definitely there is a boundary within which the MCA has to operate, and beyond that, for listed companies, the Security Exchange Board of India has to place the regulations. They have listing obligations and disclosure requirements. Let's boil down to one specific issue. Ministry has within Companies Act 2013 some other regulations, but many times it had been happening because there are many institutions which operate within the financial markets. Like board is one institution, the intermediaries, the directors are another institution. If we talk in terms of capital market, the intermediaries are, another institution. And in many cases, we find that there are cases, because, these days the economy and the different components, different blocks of the economy are not in working in isolated fashion. They are not in silos. They are quite dynamic, interacting with each other. And with the newer products and practices coming in place, definitely it creates such kind of situations which at the same time bang multiple regulators at a time, and they come into picture. And many a times it happens that one regulator overlaps the requirement and another objects. So what I mean to say is, there are two things we need to look at, towards the solution point of it. Having multiple regulators is not a challenge. The jurisdiction needs to be defined, and even if any case of overlap exists, there has to be good synchrony between the regulators, good connect between the regulators at the top level, at the governance level of the regulators themselves, so that they should not find each other competing, rather supplementing each other in terms of either easing out regulations or bringing some regulations in case it is required. Then second thing which I feel again is very, very important, which again I'll talk with global reference that has happened over many countries, developing a fair amount of understanding towards the existing or a newer regulation had always been a challenge. And when I talk about having that sort of understanding, that understanding within the regulators as well as within the takers, the stakeholders. So that sort of understanding needs to be developed well, and that can happen only when the regulators will be, integrated to a greater extent. And I would like to mention, just flagging one thing, government since 2014, as that document came to us and I was reading about it, still that regulatory body is yet to be framed. Government was proposing to have a regulatory body where the Reserve Bank, the SEBI, the MCA and other financial taxation authorities, they should come in picture and they should share their data. I mean, the KYC thing which you were talking about, where we were finding that multiple agencies in picture and multiple documents in picture and multiple formalities in terms of its operation. So they were thinking to have such authority in picture, which can give rise to a e-wallet sort of thing, which can not just ease out the KYC but also cross verifications of PAN and other informations which are supplied by the stakeholders to the intermediaries and otherwise. So, but that body is still, has not been formed. So what I mean that integration is very much required, and we need to look at from the point of view of developing fair understanding amongst the stakeholders towards the regulatory practices and within the regulators themselves.
So anybody else has comments on unified? Of course, it's not a panacea we've seen in the UK. Just having one regulator does not solve all the problems.
So it's not about multiplicity. Why we are saying multiplicity is that the moment you have multiple bodies, they work at different pace. So something gets cleared from SEBI, and then they say we also need to check from Ministry of Finance, and then your access is not there. Here you can at least knock the door. There you go. Those guys, they don't know on whose desk it should go. So then somebody assumes this thing, and then he goes through the file. He says, please brief me. And then, I'm telling you about actual practical case. And nobody knows there, and then they also play safe. That on his writing, people should not write down too much. So he will give some instruction to SEBI. Okay, he clears by chance. Again, SEBI says, no, he is not clear at this point. Again, it goes by. Then after that, you go to RBI.
Football.
It's football. Finally, private equity deal, which we had signed. I had visited twice the place, all the way, spent 2 days. And then finally, it was some technical, because the investors were some foreign investors, we just couldn't get it. Finally, it didn't happen. And so, there's so much of vested effort in these kind of things, this multiplicity of, and SEBI was very clear, you are entitled to invest. It was just a permission whether we can invest. The color of the money was slightly different. There was some foreign, some domestic. So, and they're just confused. So, I think this multiplicity of the agencies, they create a lot of problem. And in the digital world, if actually the speed is there, it doesn't take much time from one desk to other.
That plus, I think there is some synergy. FMC, SEBI merger that has resulted in a unified regulation. Yeah. It's resulted in cross-margining. At some point, it will happen, I guess, in 2018.
I have no issue with multiplicity of the regulator, as long as there is a cooperation between them. And why I say that? Because what happens, there is a difference between power and responsibility. When you are a regulator, if you think that your power, you are absolutely wrong. You have a responsibility to do something. Now, what happens? I feel as a regulator that this is in your domain, you feel it is in my domain, so that is an orphan baby, unregulated. That should not happen. If I have something which I am not able to regulate, we have to sit together and say that let us do something to regulate. The other thing is that the regulators all over the country are more of a top-oriented organization. The regulator ethos depends upon the chairman of the day. Now, what happens if you have unified all regulators and somebody comes at the top who is not right, then what type of catastrophe you are going to happen in the country?
So you're talking about competition between regulators.
So you have regulators. It's not a competition, a cooperation with underlying responsibility, not power.
What he said, KRA for the regulator.
As a regulator, I don't feel that I had a power. I had a responsibility to do something, and that is the difference.
Great. So, kind of final question before we open up is in terms of, again, something which you've experienced, and I'm not sure what your view is, but, entry barriers, the document by IOSCO which talks of what a regulator should look like, what a good modern reg. And it says unnecessary entry barriers should not be there. And we've seen the mutual fund industry where SEBI has come out with net worth requirements. Now, at least to me, I find it completely incomprehensible why you need a rich person to, you want smart investment advisors, and it's completely escapes me why you need rich people to manage your money, Mr. Garwal.
Yeah. I didn't see it from that angle, because whenever I In fact, the earlier entry barrier was different. It was just the permission. 50 crores or I think initially it was 5 crores only. 5 crores. So when we applied in 2008, I didn't find that 5 crore or 10 crore to be an obstruction. Okay, it's some kind of a net worth you're putting on the table that you have skin the game, you have something to talk about. But actually getting the permission itself was a big problem. Who is entitled to manage money? And how regulator is going to decide?
I'm on the principle. Why do you require 5 crores, even 5 lakh or even 50 rupees to manage somebody's money?
I'm with you. I mean, some kind of a solvency.
It's good for you as an incumbent now. It's good for you.
I don't think that kind of that should be
that should not be the reason.
That should not be this thing. And
I will speak as a non-interested party.
Yeah.
The issue is first of all, no one of us has a formula to know who is smart and who is crook.
Nobody is asking you.
That's what I'm saying. So you said when you have to give money to manage to the smart people should be managing the money. Now I do not have a formula to know whether I am that person who looks smart is smart really or is a crook. Every one of us thought Nirav Modi was very smart. But what you find. So the concept is you have to have a skin in the game. Now, unless until you put your money up front and you can define that your sincerity, your ability to take risk, because I should risk my money first before I want your money to be put at risk. So, skin in the game is very important. Secondly, my past conduct will not guarantee my future. I have been a very good person, you trust your money and I run away. So, the issue is that somewhere a regulator has a responsibility, because tomorrow if regulator reduces the responsibility and tomorrow there is some crisis, it will put the industry back by 10 or 15 years and the market will be in bad shape.
So let me respond. So you're saying that HDFC, which manages 2 lakh crore rupees, is able to guarantee with a 50 crore net worth the entire. So
No, it's not a case.
Listen to me. So first is that point that 50 crore is not going to cover any fraud. First, let's be clear. The second point is why are we saying that you require? It's between the investor and the mutual fund AMC, whether they trust them or not. It should not be connected to net worth requirement.
In that way, then we say it is between investors, stock and something, why we need SEBI? Because somebody needs, I tell you, HDFC today, if today HDFC withdraws 50 crore, whatever the net worth, there is no problem because it has established a thing and it is a big mission. But tomorrow, if I and Uttam wants to start a mutual fund, somebody will ask a question, what is your skin in the game? What is your stake?
But skin in the game is separate. I was coming to that. The skin in the game is required by SEBI. You have to co-invest 2.5% or something like that by the AMC into each fund. So that's a different issue. 50 crores is not solving skin in the game. 50 crores is not ceding the 2 lakh crores of HDFC.
It is an intention issue. It is at front you say that this is my intention. I am willing to stay put 50 crores.
I don't think deterrent is that big.
No, I'm on a conceptual level. I'm not 50 crores may be small amount.
But you are allowed to manage 2.5 lakh crores of public money with a bare minimum requirement of 50 crores. I don't think that's a real entry barrier.
No, it may not be. I'm just on conceptual because this applies to other people like PMS managers. Now, we have clients who are small people, who are very smart people, who come with a background of managing money for 10, 15 years. They say we don't have this kind of net worth. So it is an entry barrier in other professions. It may not be in mutual funds where you will only have large players coming in. So I'm on a conceptual framework. I'm not on specific mutual fund industry. Yeah.
Just one point I want to add is like in terms of entry barriers, I don't subscribe to this idea that there has to be a free entry. I mean what Gupta Saab has said, I'll endorse a part of it in my own way. See. India is a unique country, with levels of educational literacy at a very down level. And when you talk about the financial literacy at the bottommost level. Keeping that in mind, it's very important for a regulatory body to infuse the element of trust by ensuring investment, or you can say financial confidence, market confidence, and the consumer protection. So, there has to have some framework to assess as to really who is worthy. I mean, we can draw example from the, the spree of startups that they have gone up in the market, and even they were able, on the basis of their ideation and the quality of that particular idea, from venture capitalists they could get the money. So it's not no longer having a barrier or bar of being a listed company for entering into the capital markets. You can otherwise even remain unlisted, can source that fund. So question is, startups, the way they increased and they failed, so we gave an open entry to that.
No, sir, my level, let's agree to disagree, and let's open it up to the floor for any questions, any comments, any points which you'd like to share with the rest of us. Do we have mics here? Yes.
My question is, Mr. Agarwal, we have been seeing a lot of advertisement around opening Demat accounts which are made fairly simple, though I disagree. We were talking about 20, 40 signatures, and nowadays we see on the advertisement that it can be opened in few seconds and few minutes. Online. Yeah. Though I also understand that professional trading has been a full-time profession in much yet developed countries. What are we in India as doing to increase the trading environment in India? Because I understand this is how sub-brokers makes their money. They are investing a lot of money in getting new people, salaried professionals who are maybe earning 30,000, 40,000 rupees in a month, open a Demat account, but they would hardly trade. So what are we doing to create a trading environment in the country?
So maybe a brief response, because it's not relevant to the topic we're...
Yeah.
Broadly, yes, growth.
Yeah,
yes,
so,
but
you see, at least Mudra Oswal is doing a lot to... We have come out with two types of app separately. One for the traders and one for the investors. So, in fact, I am not that much in favor of trading per se. I don't speak for the traders. I encourage only investing, because it is very difficult to lose money in Indian markets if you are only an investor. But it's very easy to lose money if you are a trader. So that's my belief. I'm not getting into the argument on that. So, but then as a firm, we are trying to educate both sides of it, and we have running classes, and we are trying to do, and I think our competition is also trying to do, at best it is possible. So there is no dearth of trading opportunities. I think over a period, the trading cost has come down. It has come to 1 or 2 bips. That itself shows. And you see the liquidity in the market and the variety of instruments which have been coming, options, futures, and now it is going to the interest derivatives and commodities and unified markets. So I think trading environment has been becoming better and better, and it is much safer now, because with T+1, you can literally, we have 10 or 12 chartered accountants actually mining the terminals, seeing because we do about $1 to $2 billion trading every day. So we can see the flow of the trade happening, and online we can see the risk control at our end as well as for the sub-broker or whoever is the participant out there. So I think it has become a very, in digital environment, it has become very safe to trade, and trade in a big way, in the sense that you can trade billions of dollars without much of risk if the broker knows what is the risk and how much the margin he has. So I think it is a fantastic environment than what it was 10, 15 years back.
Jainji, you want to add?
I think Honorable Finance Minister has already done his bit by making a long-term capital gain tax, so that the differential is only 5%. So people who used to wait for 1 year to make it, they can sell it now, sell or buy, sell now. So that is going to increase the liquidity a bit.
Yeah. Now there is no encouragement for actually investing. Yeah.
Hello, sir. So I have a question, sir, for you. So I'm speaking as a financial intermediary. Lots of regulations are coming. The problem is we are going to face there's a brunt of cost we are having. Then there's excessive regulations coming. Again, I'm putting my money and I'm losing, our drawdown is happening because of cost. The moment I'm actually adhering to your regulations, again, you're going to change. So all the time, we are not getting a stable regulation atmosphere, sir. So as a financial intermediary, I'm bleeding, especially at least in the advisory brokerage area, since your algorithmic trading and high frequency trading has come up. So we are also a part of a stakeholder, in this financial environment. We are talking about regulation only per se on the behalf of our investors. So what is it for us as financial intermediaries? How this will help us? The question, sir, for Ramdev, sir.
I think the larger question is the whole concept of HFT, algo trading. What is the right level of regulation? I think it's...
what is right level? I think the stability of regulation, that because what I think Uttam said, the transmission of change in the regulation, I mean, is too rapid here. Like every Friday evening you keep getting something, and in mutual funds also. But I think somehow too much of activity is considered as good regulation. Somehow that's the feeling among the regulators. I mean, if something is working very well, why you have to just tinker it? Because there's a lot of trickle-down effect, huge effect at various levels. It's not about it is necessary or, but I think the sheer, the number of changes, probably it means that when you are making changes, you're not thought through. So when you make the changes, you must deeply research, think through, then make the changes so that it should be good enough for few years. But I think...
in fact, FSLRC answers this, the committee. It says that there should be no circulars and all these random things which keep coming out. There should be only one level of regulation, delegated
legislation. Mr. Gupta, he is a practitioner, he sat in the office.
I will tell you, as I said, that none of us wants to make more and more regulation. The problem is this, that when you design a regulation, you have taken into account all the factors which you had knowledge or which you could perceive. But then human mind is very ingenious. Today a regulator makes a regulation and there are 100 people working on how to break that regulation.
Of course.
So when I come to know that somebody has broken the regulation, I again put on my antenna and say what to be done. I will give a very simple example. Companies Act was in making for almost 15 years. It was in public domain. None of the stakeholders gave all the changes that were required, and they thought that it will never be passed. When it was passed, then host of complaints came, why you are doing this, why you are doing that. So the issue is that when I make a law, I am not God, I am one of you. But you people are smarter than me in breaking the law. So what do I do?
No, but I think
this is not a fair statement.
I'm not saying, see, you may not agree, but I will tell you as a regulator what I feel. I will tell you very simply. Today Nirav Modi scam has happened. Now, all the regulators, I just say that we behave like a crow and vultures. A dead body is there, every regulator like a crow and vulture has come on that. ED has come, CBI has come, RBI has come, SEBI has come. Till such time this fraud was happening, nobody question people who come in suit and tie to me, who come in big cars, because I thought that they are gods. That concept has to change. None of you question, none of regulator question, because we feel that person is moneyed person, he is doing all right. We have to change this mindset.
Another question.
Yes, please.
I just want to comment, not a question. India is an extremely regulated country, and we make regulations for sake of regulations. And just because somebody has done something wrong, your crew of vultures come on everybody and defame all the businesses. Yeah. So I think it's important in this country and the government or the powers to be matured to stop the regulating and over-regulating. That's my only comment I would make.
Yeah, no, I think it's a good point. And I think the point is not to not regulate incrementally. If there are new products, HFT has come in which didn't exist 10 years back, you obviously do need to regulate. I don't think anybody is arguing that there should not be new regulation. I just think there has to be some calibration and some more gravitas in regulation making, and which it should be, if everything is brought through regulations, for instance, only one level of delegated regulation, then maybe there will be more thought which goes into a particular...
I will add one thing. Yes. I agree there could be many regulations, but India is not the country where the regulations are very strong. There are other countries. But here the issue is, I would say openly, the biggest failure is cooperation of the judiciary. Judiciary does not appreciate what laws have been made. I will give you one simple example. In DSQ software case, SEBI had passed an order asking Dinesh Dalmia to deposit 765 odd crore which he made money. The matter went to SAT. SAT said, okay, SEBI's order is correct, but SEBI has to give list of people who have lost money and give this list to Dinesh Dalmia. So based on whatever loss those people have suffered, Dinesh Dalmia will keep on paying based on that list. So what SAT did? SAT made a thief custodian of the stolen property. And this matter went to Supreme Court in 2006 or 2007. Since then, there is no hearing in Supreme Court. So what does the regulator do?
We have comment question.
Multiple regulators working together, cooperating with each other is a wish list, which we all know. So if a unified regulator cannot be there, can there be a single body to approach to by the financial intermediaries in case there is any kind of overlap? For example, CKYC implementation, most of us have realized what all problems we have faced. So if that can be the solution.
This I will answer very clearly. That do you think that in an organization when there are 7 departments, they cooperate very well? Even within the organization, 7 departments do not cooperate very well, then what to say? He would have seen ministry, I have seen organization, I have seen bank, I have seen SEBI, I have seen any place. What's happened? As long as you have got human beings who are heading every place, in SEBI we have got 8 EDs. Now do you think that every ED is on the same page every day? No. The issue will always be there.
Her question is with respect to coordination. Is there a body? Yes, there is. It's called FSDC, but it's not really meant for you and me really. So it's a talk shop between the regulators and the ministry. But yes, I think it should be converted into a more open forum where it receives comments which are across regulators. I think it's a great suggestion. I think maybe we should write to the regulator suggesting it should the FSDC, which is
right, because we all are discussing. We all are aware, yes. We all know that right balance is required, regulating for growth. However, there is no solution. So this is the only solution which I could think of.
I think it's a good point. I think it should be kind of more open in terms of, because beyond SEBI also there's a lot of coordination which is required, and all the wisdom is not with the regulators, and sometimes it's with them, but they need to coordinate better. And there is a body which does this, but I don't think they're geared towards accepting comments from the public really. So I think we have one more question, we can take that, otherwise we just run out of time. Yeah, one last question.
Yeah, hi. The question I had is, we spoke about multiple regulatory bodies in India. I was in US for 10 years back, and there we have SEC, which is probably equivalent to what we have here in India is what we call a SEBI. And we had something called FINRA in US. It's there today. It's basically a self-regulatory organization. Now, my question is, FINRA used to basically implement the rules made by SEC in real time. What it meant is, if there was a market maker in the market having a bid and ask, because there's a concept of market maker in US, which is basically a code-driven market as well, versus an order-driven market in India. There was a 90-second rule in which if the market maker is not honoring it within 90 seconds, FINRA used to take the data in real time and penalize the broker for not having met its obligation of honoring that quote. What I feel is in India, do we really have a real-time monitoring? Say we can make a lot of regulations. Do we have real-time monitoring and immediate penalization? What I see as a problem is we make regulations, but the implementation and penalizing and immediately putting it in practice is where probably we lack.
So I think on the surveillance front, yes, there's integration. So SEBI in fact gets information from all the exchanges, all the depositories and all the clearing corporations virtually on a real-time basis. And it obviously throws up a lot of red flags. Many are false positives, many are false negatives. But yes, they do have a system, and in fact the surveillance system in SEBI is pretty advanced. In terms of whether it's kind of there's real-time flagging off and penalties, it happens. We've seen IPOs where within before the actual allotment happens, SEBI has come and frozen the allotment process because they saw some fraud. So we've seen many cases where they have been proactive, but obviously that won't be the case. Some of the judicial delays, lack of expertise in the judiciary.
And whether we need something like a SRO over here, because SEBI, SEBI is, it's like a SEC, it makes rules, but implementation probably should be given to a SRO.
So, in fact, SEBI has toyed with the idea of an SRO. They've, for mutual fund distributors, they in fact ask people to apply, and two of the applicants, they've gone to court. In fact, we represented one of them. So it's pending the Supreme Court right now. So hopefully you'll see an SRO in the near future for at least some segments of the market, if not for the entire market. So yes, it's probably a good mechanism forward. And so with that, I'd like to thank everybody for patiently listening to us, and I thank all my fellow panelists for the wonderful discussions we've had between us and with you. Thank you.
Thank you very much. Thank you. Thanks.